If you want to improve your knowledge of stock market investing, welcome to this stock market analysis video on dividends. By the end of this video, you will know what a dividend is, how to make money from dividends, why dividends matter, how to interpret dividend information, and where to find information on dividends. Before we get into what dividends are, why should you care about dividends in the first place? If you want more money from your investments, you absolutely have reason to care. Let's take a look at this chart. It shows how well $100 would perform if you invested it in 1972. If you invested in dividend growers and initiators, companies who are growing their dividends, by 2017, your $100 would have become over $8,000. For those companies which pay a dividend but were not growing it, the 100 became almost $6,000. The S&P 500 index is 500 large companies listed on stock exchanges in the United States, some of which do not pay dividends. The S&P went from $100 to $3,000. Meanwhile, those companies which did not pay a dividend only increased from $100 to $327. The difference between the companies growing their dividend and those who do not pay a dividend is enormous. Here's a second chart looking at those categories, but now for the years 1986 to 2019. The growers returned over 11% per year. Those that paid a dividend but did not grow it returned over 9%. Those who did not pay a dividend essentially broke even. In 2016, Hartford Funds found that 81% of the total return of the S&P 500 going back to 1960 was attributed to reinvested dividends. They also found that dividend income accounted for 33% of S&P 500 monthly total return between 1926 and 2015. Eagle Asset Management found that, quote, from 1871 through 2003, 97% of the total after-inflation accumulation from stocks came from reinvesting dividends. Only 3% came from capital gains. Yes, they are saying 97% of market gains came purely through dividends and their reinvestment. Last, I'll give you an amazing quote from Jack Bogle, who was the founder and chief executive of the Vanguard Group and the father of index investing. He wrote, an investment of $10,000 in the S&P 500 index at its 1926 inception with all dividends reinvested would by the end of September 2007 have grown to approximately $33.1 million. If dividends had not been reinvested, the value of that investment would have been just over $1.2 million, an amazing gap of $32 million. Over the past 81 years then, reinvested dividend income accounted for approximately 95% of the compound long-term return earned by the companies in the S&P 500. In other words, the reinvestment of dividends accounted for almost all of the stock's long-term total return. For those who are interested in where this information came from, the links to this information are in the video description below. As a quick aside, the differences in some of these percentages vary across studies depending on the years and the indices selected for the research. Now that we know that dividends are an important building block for income and wealth generation, what is a dividend? A dividend is money paid out to shareholders of a company. In the United States, most companies which pay a dividend pay it out quarterly or 4 times per year. A smaller group will pay these monthly and a few pay biannually. This means that if you own a company as a shareholder, the company will pay you for owning it. Why does the company pay you for owning it? Well, if you are a shareholder, you literally own the company. As the owner, many companies feel you are entitled to a piece of the profits. If you owned your own small business, you would likely pay yourself from the money your company made. This is the same principle as a company you own paying you a dividend. The purpose of owning a business, ultimately, is to make money. If you buy dividend-paying companies like Starbucks, Apple, Coca-Cola, or Target, they will start paying you rather than the reverse for once. A few other reasons companies pay dividends is to incentivize shareholders to buy stock in the company, because they don't have a better use for their money, and because often the company's retirement and some of the executive pension is based on owning the stock. If the employees and executives own stock in the company, those dividends are going to them as well. Before I tell you where and how we find the dividends, please take a moment to like this video. Videos like this take a great deal of time to make, and liking this video will help the YouTube algorithm get this video out to more people who are interested. How do we find the dividend for the companies that we are interested in? Let's take a look at Starbucks' page on Fidelity.com. We can see they have listed the dividend as $1.64. This means that for every share of Starbucks you own, Starbucks will pay you $1.64 per year. A share currently costs $63.33. If we take $1.64 and divide it by $63.33, we get 0.02589 or 2.59%. 2.59% is Starbucks' dividend yield. The yield is the percent of your investment you will be paid in dividends every year. Starbucks will pay you back 2.59% of what you invest at this price every year, possibly forever. Fidelity has already calculated the yield for you over here. Now I know this says 2.52%, but that is because it is calculating this based on the share price for yesterday and it has not yet updated. The great thing about knowing how to calculate this yourself is when share prices are dropping like they are today, you know how to calculate the yield for yourself. You might be thinking to yourself, 2.59%? That doesn't sound that great. How could dividends make that big of a difference? There are two reasons: dividend growth and the power of compounding. Let's first look at dividend growth. Just because Starbucks pays $1.64 per year as the dividend now does not mean it will forever. Companies like Starbucks are sometimes referred to as dividend growth companies. That is because they grow the dividend payments over time. As you may recall from some of those previous charts and studies we saw, the dividend growers provided the best returns. Next year, Starbucks might pay $1.75 per year. The next year could pay $1.90. In 10 years, it might be paying $3 per share. Because the dividend increases annually, you are getting an annual raise as the company's owner. Let's scroll down Fidelity's page to look at the dividends window. Here you can see that in 2017, Starbucks increased its dividend by 25%. In 2018 and 2019, it increased by 20% per year, and in 2020, it increased by about 14%. If we select the More option, we see that Starbucks has increased its dividend by 20.71% every year on average for the last 5 years. In 2015, it paid a 64-cent dividend. Today it is paying $1.64. That's an enormous jump. Imagine if your job gave you a 21% raise every single year. That is part of what makes dividend growth machines like Starbucks an excellent investment. Now on to the second reason. In addition to dividend growth, we have compounding returns. Some people like to have fun with dividends. For example, using the money Starbucks pays them to buy Starbucks drinks, so it's almost as though Starbucks is buying the drinks for them. However, an even better use of your dividends is reinvestment. If you buy $1,000 worth of Starbucks stock, Starbucks will pay you $25.89 every year. You could use that $25.89 to buy another 41% of a share of Starbucks if it remains at its current price, which means that you will get another 67 cents next year for a total of $26.56. Every year, your dividends will buy more and more Starbucks shares, all while they continue to increase the dividend payments you get per share. Each year, the amount you are paid grows faster and faster. It becomes a wealth-building machine. What is your favorite dividend growth company? Answer in the comments below what your best grower has been. Let's take a look at fast graphs to see how dividend growth and reinvestment plays out. We are looking at a chart for Realty Income, a real estate company. We are looking at a chart for the last 20 years. You can see the average and compound annual growth rate for the dividend is 5%. Based on the initial investment of $10,000, after 20 years, Realty Income paid out over $75,000 in dividends. Your initial investment of $10,000 turned into over $137,000. This is a nearly 14% annual return and is far superior to the $27,000 the S&P 500 earned over the same time. Switching to another dividend growth company, Magellan Midstream Partners is an energy company. Take a look at the dividend growth it enjoyed during this period and its average dividend growth of 15%. If you invested $10,000 in 2001, they would have paid you back over $109,000 in dividends. and your total return would be over $145,000. This is a 15% return, which again beats the S&P by a massive margin. For our final example, we return to Starbucks. We are looking at 20 years of Starbucks performance, although it has only paid a dividend since 2010 with a 35% average growth rate. Despite this, a $10,000 investment would have still paid out $26,000 in dividends since 2010, and your $10,000 would have become over $250,000 during the last 20 years. This 17% return again is far superior to the S&P. In fact, if you had invested $3,333 in each of those three companies, Magellan, Realty Income, and Starbucks, the $10,000 would have increased at nearly 16% per year to almost $150,000. Compare this to the Vanguard Total Stock Market Fund, an index fund which includes the entire U.S. equity market. Not only did our dividend growers beat in compound annual growth rate and the final balance, but the best year was far better, the worst year was not as bad, and there was a smaller drawdown. This chart visually shows the substantial difference between our hypothetical dividend growth portfolio and the total market. I want to highlight here that I am not guaranteeing that any dividend-paying company will perform this well, or that they will perform well at all. I am not guaranteeing these three companies will perform as well in the next 20 years as they did in the last 20 years. What I do want to emphasize and illustrate through these charts in this video is the power of dividends and compounding. Albert Einstein reportedly said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." I hope by the end of this video you feel better educated on dividends and you enjoyed watching. I encourage everyone to subscribe to this channel because I am working on a follow-up video on the pros and cons of dividends and how to tell whether a company will continue to pay a dividend, something often referred to as dividend safety. If you intend to invest in the stock market, you won't want to miss this important information. As always, good luck with your investing.